Let's look at the latest Australian economic data. Hello everyone, Florian.Heise here and welcome to another episode of HeiseSays. Grab your stein of coffee, make sure it's piping hot, because I thought we'd have a look at the latest chart pack from the RBA, the Reserve Bank of Australia, and it's the Australian economy and financial markets. Now this data is up to the 30th of July. It was released on the 5th of August, so I thought it would be interesting for us just to go through all the different charts, have a look and get a feel for what's happening on the global economy and the Australian economy. Now I've got my stein ready. I'll have a shot of coffee before we get into it, and I'll let you do it too. I've got to need it for this. So it'll be interesting to see, and let me know if there are any particular charts here that you think I should start bringing into my regular routine of things I refer to during discussions, or that might be useful, or if there's any other alternative data sources that you think would be worth having a look at. So the first one we have here is the GDP growth for the world for year ending, and you can see there's major trading partners, so weighted using Australian export shares. Well, so in the world you can see it's just all plunged. It's just all plunged. I would say that this is even steeper than during the GFC, isn't it? We scroll over here. We can see China and India. There you go. Look at China. They plunged, but they've shot right back up again. Right back up again. And India's just steadily declining. Steadily declining. And here we have GDP growth for advanced economies. Year ended. That's the US. You can see US is going down. Japan, flooding, and the Euro area going down as well. And GDP growth for East Asia. You can see Indonesia is down. Everywhere is down. Malaysia. Look at Malaysia, how far it tanked during the GFC, and then it shot right back up. So everything is heading down. Next we have inflation for advanced economies. Now, this is based on the new school definition of inflation, not simply the increase in monetary supply, but it's goods. And you can see here with the ABS, now because everyone got free child care, we actually got deflation apparently, while all of our food costs are going up anecdotally. So, take it with a grain of salt, but nonetheless we can see, look at the US, down, everything just has fallen down. We go over here to China. Inflation for China and India, all heading down. Look at India, over 5%, 5 to 10%. No wonder there. I think India just didn't reduce their Reserve Bank, central bank didn't reduce the interest rate. So we've got labour market for advanced economy. Look at the unemployment rate, and the US measures it differently to us, but over 12%. Wage growth, year end. You can see Euro. Down, down, US shot right up, down. Inflation for East Asia. Wow, look at Malaysia. Deep into deflation. Deep into deflation, everyone. So what do we have next? We've got China activity indicators. Now this is interesting because there's some discussion about all the different indicators, the activity indicators from China. The satellite imagery and all of that stuff. So let's have a look what they have here. Here's manufacturing PMI, and it's a diffusion index, and it's like it tanked. 50 is the average, is considered neutral. So it's slightly positive again. Industrial production, again, it tanked and it's crept back up. Fixed asset investment tanked and has shot back up. Real retail sales have tanked and have climbed back up. Still haven't gone up to zero. So China residential property indicators. So you've got new property prices, the official, and the alternative. The alternative is from the China Index Academy. You've got investments for land purchases and other investments. You can see, look at that plunge. It's coming back up slowly. Floor space sold plunged again. Inventory sold and it's gone back up. So it looks like the Chinese economic activity is returning, if you judge by these factors, which could be a good thing for Australia, unless there's more social issues, or more global conflict issues, or more trade issues. Because a significant portion of our exports are to China. But will this just drive up iron ore? Increase demand there, help Western Australia improve the desires for a secessionist movement over there? Will it flow through to other parts of our economy as well? So China, total social financing contribution to 6 months. Annualized growth, you've got business financing, and there's a debit swap adjustment, and household loans. So let's look at business financing is creeping up pretty significantly. So China's gross output of selected products, and you've got electricity generation. Look at that plunge, everyone. Electricity, glass, and cement plunged and has climbed right back up. Steel production plunged and has shot right back up. So steel's something we need to keep an eye on, everyone. So next we have Australian growth. So GDP growth, we can see here, this is the year ending, and the quarterly. Look at that, we've got our first negative little blip since a long time. Where's the recession Australia had to have? The chart doesn't even go back that far. The chart doesn't even go back far to our last recession, because remember, you need 2 quarters of negative growth to technically be a recession. So, I mean, there's no surprises there, is there? Over here. So we've contributions to GDP growth. So here's GDP. In the March 2020, you got imports, government, and mining investment. I'm not surprised. Exports are down. Non-mining investment is down. Dwelling investment is down. And consumption is down. So government and imports and mining investment are keeping us going, guys, for GDP growth. Or the biggest contributors. So mining and non-mining activity. So here you've got mining. Net of mineral-related imports. Components are contributors to year-end mining activity growth. Contribution from changes in inventories not shown. So we've got here, we can have a look, mining investment. There we go. So I remember this. This here, see here around 2012, around there. That's when we just started doing all this mining work. And it just went crazy, that mining investment. We were doing... I had 4 people working in an old Queenslander that we were living in, just working on submissions for builders to put in tender bids for mining projects, one after the other. It's good. So state final demand. Have a look here, Western Australia, rest of Australia, for year-end growth. Western Australia, it's doing better than the rest of Australia, isn't it? And Victoria and New South Wales. So, consumer price inflation. Exclude interest charges prior to September quarter 98. Adjusted for the tax changes in 99-2000. I mean, there you go. Apparently, CPI is down. So, let me know in the comments if you agree with that, everyone. How are you finding the cost of your goods? Are they getting cheaper? Doesn't feel like it, does it? It doesn't feel like it at all. So, measures of underlying inflation. You've got the weighted median, true median, CPI, Excel volatile items, excluding volatile items. You can see there. Do they have a measure showing increased money supply? I'm sure we'll get to that later. Tradable and non-tradable inflation. So non-tradable, quarterly, seasonal. I mean, there we go. It's the same thing. So let's go down here. Household sector. Household income and consumption. So consumption is down. Disposable income has slightly ticked up, everyone. Some people are better off now than they were before. Look at the savings ratio. It's shot up. 5%. So, look at that. Just 2008, boom, savings shot up to 10%. So at the GFC, we started saving like mad. But there's that trough there in our savings. 0% savings. Under 0% for some time. And we wonder why we're in a mess. Consumer sentiment. So since 1980, there you go. Look at that. We're down below the level of, well, we're not as bad as the GFC, but we're getting close. We're getting close, guys. But it's jumped back up, so we'll have to see. We'll have to see if it keeps going. So private dwelling investment, chain volume quarterly, and you can see that's trending down as well. It's trending down. So private residential building approvals, and as we've discussed this in several videos, that it's going down. A lot of construction jobs are at issue. We can see here between here, look at the total, look at the peak. If we jump to this chart, we can see the Foreign Investment Review Board. You can see that peak. And a big portion of that was for foreign investors, driving up demand for residential building. And I guess, I'd argue, we see from here, property prices have gone up. We can have a look here from 2006. So we can see here. So you can see why property has gone up. I wonder why. I wonder why we see that growth. There you go. It's the only game in town, guys. So house prices and household debt ratio to a household disposable income. This goes back to 1990. We can see that's household prices are slightly going down, depending on who you talk to. At least the spruikers aren't saying it's all just going to be perfect and roses again. Household debt ratio, we're approaching 2. Bloody hell. I'd love to see this go. I mean, look at that. Look at the 90s, how much lower it was. Look at how much lower it was. Everyone. And this is why. This chart here is why. I'm going to bring this back. I'm going to bring this in the ratio, I think. This is why people feel like they're not getting ahead. You're talking about 5 times your disposable income. Just think about that. When it used to be, what, the 90s? 2.5. And wage growth. Oh, wage growth has been. We don't even talk about that, do we? We don't even bring that one up. I'll just put this chart here. So household wealth and liabilities. Okay, percent of annual household disposable income. The net wealth is... Whoa. Huh? Wait, what? Percent of annual household disposable income. Over 600%. What? I knew we were bad. Am I reading this right? Household disposable income is after tax, before the deduction of interest repayments, and includes income of unincorporated enterprises. Wow. Household wealth and liabilities, percent of annual household disposable income. So we're hitting 700%. Dwellings is right up there. It's the big chunk. Then financial assets is 400. And liabilities is 200. Wow. That's the one to worry about. But this isn't going to be spreaded evenly, is it? So here's house prices. Year-end growth, seasonally adjusted. We can see here ABS, CoreLogic, Residex, APM. I mean, which one do you trust, guys? Home loan commitments, total, owner-occupier, investor. So investors are going down. They're leaving the markets. Total and owner-occupier are going down. Down. Everything's going down, excluding refinancing. So business investment as a share of nominal GDP. There's the last recession, everyone. There's the last recession. Look at that plunge there in business investment. Look at that plunge. Look at what has been happening since just 2012, since the mining boom started to taper off. So capital expenditure, mining and non-mining. So here's mining. Dots are firm expectations for 1920, 21-21 adjusted for historical differences. Okay. So we can see here, they're expecting, I'll finish the chart, they're expecting that. And they're expecting that. We've got business investment components. It's a share of nominal GDP, machinery and equipment, building, and engineering. So there's the mining boom, guys. Engineering has just plunged. Industry share of business investment. Okay, mining, there you go. Like, this is the mining. was a big boom, guys. It was a big deal. There was a lot going on. A lot of people may not realize how big it was. It was just crazy. It really was. And we were quite fortunate to get a slice of that pie. There's a small, tiny architectural practice here in Brisbane that started with nothing. We managed to get a slice of the mining pie, everyone. And it's led to us, well, developing a whole lot of skills in volumetric modular construction. It's leading to work now. It's funny that. You never know what one thing leads to another, doesn't it? So you can see, there you go, look at construction, financial services. It's all down the bottom. So we'll have to see where it trends. But it just shows you how big that mining boom was, everyone. So private non-financial corporation profits. So there's non-mining and there's mining. What do we got here? We've got lending to businesses, large businesses, medium and small. And we can see, well, lending slightly gone up to large businesses. And what's this one? This is the NAB Business Survey. Can you see it? We got business conditions, plunge, business confidence plunged, shot back up, capital utilization plunged up. So this is the average since 89, and well, there you go. Capacity utilization, we're down. Business confidence down, up. Business conditions down and up. So we've got credit. Which one's this? Credit and money. Credit and broad money growth. There you go. There's broad money shooting right up. Credit going right down. We've got housing credit growth, 6 months annualized, and investors. So investors are going down, everyone. Monetary aggregate growth. There's the M3 and there's the currency. We need to look at that old definition of inflation, everyone. Look at that. Credit growth by sector. Housing, pretty flat. Businesses are going down. Personal, plunging. So factors of production and labor market. So you've got factors of production, net capital stock, working age population, nothing too exciting happening there, no drastic movements. So the wage price index growth, there we go. We're heading down to 2%. I can't say I'm surprised. Excluding pay and bonuses. Capital ratio. So capital labor ratio is up. Capital output ratio. What can we say about that? Unit labor costs growth, non-farming year end. So there's the unit labor costs. There's the average earnings per hour, which is going up. Labor productivity per hour, which is slightly ticking up. But it isn't, nothing drastic. So here we have the employment and participation rate. So the participation rate and the employment to working age population ratio. So we can see here, look at that. Look at that plunge, guys. The participation rate is now back to where it was in 2004. So how many people have left, given up? How many people aren't participating in the economy? This is the thing. That's a drastic move. You may get people that are unable to ever get back in. And working age, employment to working age population ratio. It's pretty bad as well. That's going to leave big, scarring on the economy. Employment and hours worked. There's employment. There's hours worked. There's average hours worked. It's down since 2008. See how the average hours worked has been trending down since 2008? See that? That steady trend down. While our total hours have been going up, while employment has been going up. This is because our population has grown. Per capita, GDP per capita has gone down. We're below trend. We're doing worse off. So they'll say GDP has grown. GDP has grown. But if you look at it a per capita ratio, we're all getting worse. So average hours worked has been going down. And that's long before. That's a trend. That is a trend. People are working less. So they're gonna get less. That's a trend, guys. That needs to be addressed. So here's the labor utilization rates, the underemployment rate, and this is from the ABS, and the unemployment rate. So you can see, I mean, it's shot right up. Underemployment over 12%, now hovering just under 12. Unemployment rate is up at 7.4. Combining these two are the important number. They should show that at the top. They should add that again. Job vacancies and advertisements. So there's the vacancies, the ABS survey, and there's the advertisements from the ANZ survey. So advertisements have slowly ticked up. We'll have to see how it goes. And that's all to do with business confidence and conditions if you're going to take people on. Regions and industry share of, state share of output, nominal. We've got New South Wales, Victoria, Queensland, Western Australia, South Australia, and Tasmania. Well, I mean, think about this. If Victoria takes a big hit down, they're saying it'll take a 10% hit or something. That's going to affect all of us with the increased lockdowns that they have. So state unemployment rates. There's Victoria, New South Wales. Oh, we're getting close to 8%. Tasmania, Western Australia, and what's this? We've got South Australia is over there, over 8. Not looking too good. Industry share of output, other business services is up above 14. You've got retail. Let's look at retail. Down. Construction's heading down. Mining's gone up. Agriculture, down. Look at all these trends. Just look at the trends. Look at manufacturing, everyone. From 14% back in the 90s down to 6%. Just look at that. We've become a service-based economy. Agriculture's even down. Wow. Mining's taken a big growth. Big growth. So employment growth by industry. Household services shot up. Construction up. Retail up, mining pretty flat, took a dip and is up. Business services up, public administration, other and manufacturing slightly ticked up since 2013. And here we have the government. The Australian government budget balance, percent of nominal GDP. I mean, what can we say? No one's surprised. State budget balances, same thing. Everything's going to be looking pretty depressing when it comes towards budget balances. Public construction work done total. You can see that huge peak there, and we tracked back down. Building and engineering, they're both sitting low. We'll have to see if they will actually roll out more activity in that construction sector. So taxation, revenue growth. Here we've got the total. Household income tax is the yellow one. Then you've got corporate income tax is green. GST, so GST is not that big. Look at that plunge there for the GFC, guys. So we'll have to see where this plays out here. Look at all these other taxes. They need to simplify our tax system. They really do. I would love to see drastic simplification of our taxation system come out of this whole process. So, commodity prices. Index of commodity prices, and the average is 100, and, well, it's been below there. So it's the 18-19 average. So we're not at the 18-19 average, guys, which has a big impact on Australia. So base metals, rural, and oil prices. Rural is the, what is that? Index of commodity prices, sub-indices. Okay, so we're sitting there. It's gone slightly up, gone slightly up. Oil plunged and has recovered a little bit. Bulk commodity prices. Iron ore, thermal coal, coking coal. And these are important things for our economy. And there's the average Australian export prices there. Thermal coal is down here. The spot price and the Australian export price. Okay, so we're exporting iron ore below the spot price at the moment. Coking coal slightly above. And okay, so there's a bit of a delay. So thermal coal is going to head down. Again, it looks like iron ore is going to head up. And looks like coking coal is going to head down. I wonder if that will come back up because of demand from China for steel production and increased energy. I wonder if that will head up. We'll have to keep an eye on that. In terms of trade, can see here, I mean, slightly fell down, ticked back up. We'll have to keep an eye on it. We're still above the 17-18 average. What else do we have here? So a lot of stuff to go through, guys. A lot of charts. Balance of payments and external positions. Export volumes, resources. It's sitting pretty flat. Services have taken a hit. Rural and manufacturing, not really moving that much. Maybe trending down a bit. You've got bulk commodity exports, iron ore and coal. Coal is nearly at 100 million. And iron ore is well over 175. So import volumes, consumption, services. Services have taken a big hit. Intermediate and capital. I mean, we can see capital is going down a little bit. Intermediate is kind of sitting there. So exports by destination. Share of total values. China is still our highest, over 30%. We'll have to see how that plays out. This data is only from 2018, so we'll have to see what happens here moving forward. Japan has come back up, and you've got the EU. That's going to change. South Korea, India, and the US. It'll be interesting to see how Brexit materializes, if that actually has an impact on our relationship with Britain. So current account balance percent of nominal GDP. We can see the trade balance has bumped up, current account balance has shot up, and net income balance has slightly ticked up. So net capital inflows, you've got debt and equity. I mean, there you go. This is definitely going to be an interesting year, everyone, to follow, see what's going on. So net foreign liabilities. So with equity, short-term debt. So equity's plunged. Short-term debt slightly ticked up. Long-term debt has slightly gone down and total has gone down. So we've got external positions. Consumption after hedging quarterly. You've got gross foreign liabilities. You've got the foreign currency in the Australian dollar. I mean, gross foreign assets. They're shooting up. Have to keep an eye on it. Okay, interest rates. The Australian cash rate target. I mean, what can we say, guys? We've been keeping an eye on that for some time. We've got the policy interest rate, and we look at Euro, I mean, in the negative, Japan in the negative, the US virtually at zero. The Australian cash rate and 90-day bond yield. There's the 90-day bond yield. There's the real cash rate. This is negative. And there's the cash target rate. I mean, there you go. So policy interest rates for selected advanced economies. You can see here Switzerland is in negative. Sweden has just crept back up to zero. Canada, where are they? Well, everyone's virtually at zero, guys. So here's monetary policy for China. The 1-year MLF, 1-year benchmark deposit, 7-day repo monthly average. So their repos jumped up a bit. Reserve requirement ratios are all heading down. The 10-year Australian government bond yield, I mean, what can you say? It's trending down, just like everywhere else in the world. So policy interest rates for emerging markets, I mean, everyone is doing the same thing. Everyone is doing the exact same thing. I mean, that's crazy. How low can you go, guys? We're going to see more people go into negative. This is unprecedented times, isn't it? 10-year government bond yields. I mean, there you go. Look at that. You get a China bond. Nearly 3%, guys. Quick. Borrow in Germany and head to China. What do you reckon? Brave enough? So spread between Australian 10-year bond yield and the cash rate target. We can see there. They're not really hitting their target, are they? I mean, they're getting close. Australian non-financial corporate bond yields. Well, look at triple B and look at A. Everything's going just heading down. Trending down, guys. Trending down. The difference between the Australian and US 10-year bond yields. So you can see there's a slight difference. There's been that dip for a while. Now it's shooting up. Australian non-financial corporate bond spreads heading down. What do we have here? US corporate bond yields Triple B, AA, and 5-year swap, everything heading down. Chinese corporate bond yields have ticked up and they're flatlined. Would you be brave enough, guys? US corporate bond spreads, I mean, all plunging down. We've got emerging market bond yields, Euro, Latin America, and Asia, everything trending down. Everything trending down. Seems to be a common theme. So here we have variable home loan interest rates, the major banks hovering. I'll change my pen. Hovering around, between 4 and 5%, close to 5 virtually. Outstanding loans are plunging down, and new loans. Look at that, new loans down to 3. Let us know in the comments what you're getting for yours. If you managed to convince your bank to go you under 3, you playing the game. So fixed housing interest rates. There's the advertised, and there's the swap rate. I mean, you can see that. Housing interest rates. There's owner-occupiers for interest only, and investors. I mean, I can understand why people do interest only. Just scares the bejesus out of me. It really does, particularly for owner-occupier. I mean, for me, that's a sign of desperation. But then again, interest is so cheap at the moment, if you want to save on your capital. So Australian business lending rates, we got small business, medium and large. I mean, everything is trending down. Everything is trending down, guys. Everything is trending down. They're doing everything they can, aren't they? They're chucking everything at every can at the road. So you've got the share price accumulation indices. So it's a logarithmic scale ending December 94 for 100. I mean, there you go. You can have a look. Shot up, took a plunge, and down, and shooting right back up again. Share market go boom, guys. So advanced economies share price indices. There you go. It's almost like the supply of money is inflating the prices of these shares somehow. Do you think that could be? So we've got Australian share price index, all other sectors. Resources, boom, look at that. Financials aren't doing too well. So that may be our resource sector. People are hoping on a China-fueled recovery and that manifesting in the Australian resources. So emerging markets share price indices. We can see the emerging Eurozone, up, everything up. So we've looked at interest rate plunging, unemployment high, all of these other things. But the shares are just shooting up, everyone. And it has to be the increase in money supply. Has to be. So bonds on issue in Australia, non-government bonds, Australian government and state bonds. So, well, what can we say? Let's just look at this chart here and then look at this chart here. So total non-government bonds on issue, financial, non-corporate. So financials are going down, non-corporate, non-financial corporations, non-residents, and asset-backed securities. So you've got non-government bond issuance, domestic issuers, non-residential issuers, and offshores. Got non-government bonds on issue in Australia, financials. There we go. We can see, non-residents have slightly taken a hit, but no drastic, exciting moves in that. Not yet, anyway. US and Euro area corporate bond issues. I mean, damn. Look at that. Emerging market corporate bond issues. That looks interesting. Wow. And we have exchange rates. The Australian dollar trade weighted index. You can see the real. It's taken a plunge and jumped back up. We've seen that in the dollar. The official reserve assets. What's this? The reporting methodology for official reserve asset data changes in 2015. We can see here trending down, going side to the right. For exchange market intervention transactions, data up to 30th of June 2019. A positive value indicates a purchase of foreign exchange, while a negative value indicates a sale of foreign exchange. So the RBA has been doing nothing since, well, what is that, 2007? The Australian dollar, we go yen per the Australian dollar, US per Australian dollar, and euro per Australian dollar. I mean, there you go. We're everything's going down compared to us. Go Aussie, Aussie. US dollar. I mean, there you go. US dollar starting to go down. In the world, we're seeing that manifest in other things. What do we have here? Select Asian currencies against the US dollar. And Thai's going up. Singapore up. Everyone's going up. So the US is going down against everything. Except Indonesian and Indian. Look at that over the years. Look at that. If we look at it from, the GFC, everything plunged to climb back up and they've been heading down. Heading down. So G3 nominally trade-weighted indices. Got the US dollar, the Japanese yen, and the euro. China renminbi. We can see the yuan here. I mean, there you go. Yuan per US dollars. Hovering around 7. I mean, aren't they playing a game there where they're devaluing the currency? It's all fun and games, isn't it? Australian bank profitability. Everyone's worried about this. Return on shareholders' equity after tax and minority interest. The majors are hovering over 10%, and the minors are over 10% as well. Of course, this data doesn't incorporate now, which is going to have a big impact. Major banks' net interest margin. I mean, there you go. Over 2%. What do we have here? So Australian banks' profits, major banks. I mean, this is, it's good to see, but we'll have to keep an eye on it for the future because of how much money some of these banks have put aside towards their... Okay, Jojo, if you go upstairs, I'll make you some hot chocolate, okay? I'm just recording. Hot chocolate calls, everyone. It's going to be a long video. I'll get through it. Good on you. Whoa, 36 minutes. Well, good on you if you're enjoying me looking at charts. I'll release this one later tonight. I think it'll be a good, long night video. So banks and non-performing assets, consolidated global operations, share of on-balance sheet assets. You can see here total and impaired. I mean, no drastic movements, but a huge plunge since the last recession. So we're going to see a huge uptake from this recession. So banks' non-performing assets. You've got total, share of assets by type. Look at businesses. I mean, we haven't really seen the impact of this recession yet because there's so many interventions in the market. There's so many things propping us up. Capital ratios. Consolidated global operations of locally incorporated Australian authorized depositing institutions. You've got the banks, Tier 1, CET, Tier 2, credit unions, and building societies. So, percent of risk-weighted assets break in March 2008 due to the introduction of Basel II for most ADIs, break in March 2013 due to the introduction of Basel III for all ADIs. So, okay, that ain't looking too good for your building societies. Could that present an inherent bail-in risk, everyone? Funding composition of Australian banks, domestic deposit, short-term debt, long-term debt, securitization, and equities. Okay. Adjusted for movements in foreign exchange rates, tenor of debt is estimated on a residual maturity basis, includes deposits and intergroup financing from non-residentials. And that is it, everyone. These are all the latest from the chart pack of the RBA. Thank you for, sitting with me and going through all of these. It's interesting to see what's going on around the world and to keep an eye on it. What do you think the future is going to hold for us, everyone? Do you think we're going to start actually seeing this increase in monetary supply manifest in inflation in our consumer goods? Will they ever admit it? As always, I have to go ahead and make a hot chocolate. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I create, there are a few ways you can. You can join the channel on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy our merch from HeiseSays, use Gold Pass at the Perth Mint, or support us via PayPal. Take care, everyone. Have a great day, and I will see you in the next episode.